Good morning to everyone. Just want to give you a quick summary of what I've learned over the last 2 weeks after having met some of the most important investors in the world and CEOs in London on a global scale and recently in Brussels too in the financial sector. So the first message is global economy. Global economy, it's slowing. It's slowing in Asia as the China reopening is not as strong as thought. And the reason why China is weaker is because there is too much domestic debt on the real estate sector that is now hurting the domestic economy. Xi Jinping is asking for restraint in consumption and saving. And that means de facto the consumer machine of China is slowing. And as a result, the China reopening is not as strong as expected. Europe, domestic consumption is slowing too, and it's mainly led to the fact that the interest rates rise. It's now hurting the consumer for mortgage repayment, credit card, and even public debt expenditure. By far, the worst economy in terms of trading remains the UK. In London, I met many CEOs, and there was one unanimous consensus. The worst economy globally right now, it's the UK. And I think it has to do with the fact that inflation there is twice as high as anybody else, due to a Brexit supply shock, and at the same time by the fact that it has the highest level of indebtedness of any G10 country when you consider private debt, corporate debt, and public debt. If you add the fact that the UK has a twin deficit, so current account deficit and fiscal deficit of more than 11% compared to 8-9 for the US and less than 5% in Europe, this adds basically to the pressure and the squeeze in the UK. US, two-tail. The Inflation Reduction Act, super positive for the reindustrialization of the country, but the crisis in the regional sector keeps on biting, and hence less availability of credit means that there is slowing in the real estate sector that ultimately drives the economy. Second message, hence, comes on inflation. We see clear data that inflation is slowing, and the majority of the inflationary pressure led to the Ukrainian war are now abating, the COVID shock supply chain are abating, and we're now seeing a normalization. So we expect core inflation to start slowing, and we see it on our big data on a day-by-day basis, month by month and year on year. That means, in our view, that the US will likely pause or maximum add another 50 basis points, no more, and in Europe that we're probably going to be there. And we're going to start seeing numbers slowing already across the summer. Third, that means for investing, fixed income remains a perfect asset class to own, given where rates are and the mix of growth, risk, reward that we're seeing right now in the financial sector across fixed income. Last point has to do with the most important trend that I've seen, green transition. Any CEOs I've spoken to is focused on it because ultimately this is going to be the most and strongest industrial trend for the next 20 to 30 years. Will be accelerated by artificial intelligence, but we all live on a real planet. We all need water, clean food, clean energy in order to keep the planet sustainable. And this remains, in my view, the strongest long-term trend I see. That's what everyone is focused. And I think as a result remains probably one of the best trends to invest